Good morning, everybody, and thank you very much for joining us for the June edition of The Balanced Perspective. I'm your host, David Levinson of Ned Group Investments, and we're joined on the line by Ian Power, the CIO of Truffle Asset Management. Ian, thank you so much for joining us today.
Morning, Dave, and morning to all the listeners this morning.
Before we kick into our Q&A with Ian, just to recap some of the major stories taking place around the globe over the course of the last month. So we had Emmanuel Macron in France holding on to his seat, but we had prime ministers changing over in Sri Lanka and Australia under very different circumstances. Locally, the KZN, and our thoughts go out to our colleagues there, experienced their second severe flooding in the course of just a month or so. And then on the opposite end of the spectrum, the dams outside and feeding into Nelson Mandela Bay are around about 12% capacity. So fingers crossed for some nice seasonal winter rains as the cold fronts start making their way east from Cape Town. On the subject of climate change, I think India is experiencing extreme heat temperatures of around 50 degrees Celsius. And what we've seen there is the actual central bank in India upping rates to protect the consumer against rising food price inflation. Russia stubbornly continued their invasion of Ukraine, and in turn, this is again throttling at least global supplies of grain, which of course countries in North Africa, for example, import as much as 90% of their food from the likes of Russia and Ukraine. So quite a humanitarian crisis to potentially play out there as well. On the economic side, so the Fed hiked rate by 50 basis points, which is, I believe, the single biggest hike since the year 2000, as did the SARB similarly hike rates, as does Australia for the first time in as much as 13 years. So Ian, I'm going to bring you in here. The fact that these central banks are upping their rates, I guess, suggests that they're not erring from their inflation targeting mandate. One thing that's quite interesting is the R word, and dare I say it, recession is starting to feature in economic circles, which is almost counter to what the Fed are doing in terms of upping rates. That might, in fact, exacerbate the risk of recession. So I'm just quite keen to get your view in terms of how the global market might be playing out, because the recession word is very different to what we were saying a year ago, obviously before the Russian invasion of Ukraine. So maybe a quick picture in terms of your global outlook and also what you might read through here for South Africa.
Yeah, okay, thanks, David. So I think the first point is that central banks around the world have been increasingly left behind in terms of monetary policy. And I think if you look at what we've been saying throughout the whole of 2021, and you look at our presentations, we were consistently saying that central banks are going to be chasing, they should be acting, and they didn't act because, remember, inflation was going to be transitory. And I think the worrying factor now is you're seeing those second round effects and an anchoring of future expectations starting to manifest in higher wages and that services element of inflation. So we are expecting the goods piece, the actual durables portion, to start to decline, but just the services component is annualizing between 3 and 4% per annum increase. And I mean, wage inflation across the board is now accelerating north of 5-6%. So I think from a Fed point of view, they have a dual mandate, one in terms of the job market, which is very hot, very tight, as we know. There's almost 2 jobs available for every one unemployed person in the US, and you've got wage inflation accelerating. And all of these cost pressures, I think, are really starting to make inflation a bit of a political hot potato for many of the incumbent governments. So I think they need to be seen to be combating this, and I think hence the fairly aggressive start in terms of tightening monetary policy, which, despite slowing global growth because of the supply chain issues, because of COVID, because of the European crisis that we're seeing, we think that central banks are going to continue to push up rates into the face of that. So what it does, I guess, is it makes for a backdrop for markets, which means you've got liquidity being drawn out of the markets, you've got the potential slowing of economic momentum, but at the same time you've got quite a strong cost push. So I think that really talks to the point we've been making consistently over the last 12 months, is that there's a big risk to earnings and margins for many of these companies, where companies are having to pay up for wages, pay up for workers because of onshoring, because of the more populist and national policies which are starting to roll out across various geographies, and all of this is inflationary. So I think probably means that markets are in for a higher bout of volatility, and once again, stock picking critical to sail and navigate through this without losing capital.
Thanks, Ian. I want to get to the stock picking side at the end of this next question, but the topic for today is around soft commodity prices. And I mean, there are a number of factors here. We spoke about the Ukraine-Russian conflict, global climate, even through from California, South America in terms of coffee there, Indonesia even, and a lot of protectionism as well coming from governments in terms of what they're allowing to be exported. I think Indonesia may have just lifted a ban there in terms of their palm oil. I think India have quite a few protection policies in place as well. This is all kind of leading towards a higher food price inflation. Tiger Brands said last week, I think they say the inflation on grain is currently 4-5%, but they expect it to even go up to potentially around 15%. I know you hold the likes of, I want to get this right, sort of in the food producer space, AB InBev, Astral Foods, and then on the retail space, Pick n Pay and Woolworths in some of your portfolios. So I'm just curious to know is how might these high prices affect your thinking on these certain counters or companies at least. So whether some are price takers versus price makers, maybe give us a thought into some of your thinking there.
Yeah. So I think generally in a sort of a rising inflationary environment like we're seeing, you don't want to be exposed to a lot of the producers or the manufacturers because they take the biggest margin squeeze because they typically are in a weaker position, negotiating position vis-a-vis some of the big retail chains which have massive market share. And I think, we're expecting food inflation to accelerate up to close to the 10% number by the end of the year. And I mean, typically, food retailers do well during that type of environment. Astral, I think, is a bit of a different one because whilst they are experiencing higher feedstock prices in terms of maize, they currently have very, very strong pricing because imports have collapsed into the country. So they are able to pass on lots of the price increases in terms of higher soya, higher maize, in terms of chicken prices, and I think protect their margins at a time when imports have come down by between 6 and 10% in terms of the SA market. So I think that business really surprised on the upside, and as we've been saying, we felt that there was significant upside in that stock, and notwithstanding the sell-off you've seen in some of the SA Inc. and some of the other shares, likes of Astral's really come through that quite nicely. AB InBev is a different one, obviously exposed to the beverage and the CSD and I guess mix market, and there they are suffering to a greater extent because of obviously the softs in the sense of the barleys and all the soft commodity prices which go in there, and they don't necessarily have the same level of pricing when you look at what the aluminium price has done and many of these other commodity prices. They also hedge forward on a sort of a rolling basis, so they're yet to experience the full impact of the rising cost of goods sold. But having said that, there is evidence that consumers are looking to get out and experience that services sector of the market, which perhaps we haven't been able to do given COVID. And there certainly does appear to be a propensity for consumers to accept the higher prices, in terms of some of these inputs. So, perhaps they are not as badly impacted as we think because, people want to go out to a pub and share a drink with a mate, and I guess, not too concerned about the extra cost on the beer. But yeah, I mean, the businesses are being impacted to a greater or lesser degree, but you're seeing pricing coming through for all of these businesses, which I guess takes us back to the first point about inflation in the system and why central banks are being aggressive and probably continue to be aggressive to hike into this.
And maybe it's not unique to South Africa, but there's almost kind of this dichotomy forming when you think about, the release from COVID and people wanting to go out and spend money and experience things. All this pent-up travel over the course of the last 2-3 years has taken place. But then also this food price inflation. Those on the lower income bracket are spending as much as 40% in sub-Saharan Africa of their disposable income on the likes of food. So they, it's a that unfortunate situation from a humanitarian point of view that they'll feel a lot of that pinch as that inflation starts to read through. So in terms of the South African consumer, given the global backdrop being relatively precarious at the moment, I want to get a little view into your thinking in terms of managing a balance fund. What sort of tilt are you looking at in terms of your SA Inc. Versus some of the global stocks? And is it time to maybe be a little bit cautious and maybe slightly adjust your exposure in terms of fixed income, cash and bonds?
Yeah, so I think that's right. I think from a valuation perspective, I think we've got the benefit in SA of having very cheap risk assets in the I guess shape of equities and bonds, the fixed rate bonds. So our bond market really offering great real returns in the context of very little yield globally, and our equities are still fairly cheap. And SA corporates have delivered better than expected returns in terms of their recent earnings update, and generally those our shares don't look expensive. Now, of course, we've got the global macro where there's perhaps the opposite, where value is certainly in the US market is hard to find, and maybe we're going to have a recession in Europe, and then maybe a recession in the States next year. So lots of volatility there. But I think from a positioning point of view, we have been we were fairly defensive in the beginning of the year, short, long duration assets, no tech, no long duration fixed income in the portfolios, and focusing on, protecting capital, which I think we've done well. And into the sell-off that we've seen, over the last month or so, we've actually deployed a little bit of capital back into some oversold positions. And I think that there is still decent value in SA risk assets, but the volatility around the pull to par or the mean reversion is probably going to still be fairly high. And some of the big factors that we're thinking about that are concerning us is the China COVID zero policy. It looks as though they've got their backs against the wall. We're expecting some pretty major stimulus to come out of China sooner than later, but they need to decide what they're doing in terms of COVID. And then, of course, the Russian-Ukrainian conflict, which is just going to grind on. And I think talks to your earlier point about, supply shortages on top of COVID, induced supply chain shortages. So I think these are factors which, markets and global growth is going to try and absorb. But ultimately, when you sort of think about it from a consumer point of view, and you mentioned the lower LSM, which is probably the sort of at the epicenter of what we're seeing, given that transport and food is a much bigger percentage of their spend, it means that consumers are going to have less discretionary spending power, and also tilting at a time where wanting to move away from sitting on your couch buying things online to going out to the pub, maybe going to the takeaway, getting something to eat with your mates, or getting on a plane or a bus and visiting somewhere nice. So I think there's a change in behavior coming, but I think the discretionary portion of spend is going to come under pressure.
Thank you very much, Ian. Sorry, it's typically I'm busy quickly typing away. There's quite a lot to take in. I've even lost track of time, but I think we're probably close to our 15 minutes. So thank you very much for joining us again today. I really appreciate you taking the time out of your morning. And of course, your wise words have given us much to think about.
Thanks, David, and thanks to all the listeners who signed on for the call this morning.
Yeah, and then just to recap some of Ian's comments, as comically was typing away there and didn't realize he had finished tapering off his answer. But central banks have acted a little slow across the globe, as Ian mentioned at the onset of today's chat. Imports into South Africa have fallen quite drastically, so food producers are passing on some of these costs and protecting their margins. As Ian mentioned, Astral Foods' position they hold and their earnings have surprised on the upside. Consumers in South Africa will have less discretionary spend, particularly as inflation starts to feed through. SA equities are still relatively cheap, and earnings have been better than expected. And this is a little bit counter to what we're seeing in the US, where Ian made note of value being quite hard to find. And then on the macroeconomic side, the risk of recession across the EU and the likes of the US next year are an increasing risk, as is China a concern given their COVID zero policy there. But maybe down the line we'll see a little bit of government infrastructure spend there as they start to get the economy ticking over a little bit faster. And then, of course, the conflict again in Ukraine and Russia's invasion there will continue to throttle global supply chains, and that doesn't look like ending anytime soon, where we're currently sitting. So I am a little bit short of breath. Thank you so much again. Take care, and we'll catch up with you next month. Thank you.